Okay, this is Chapter 8, Part 3. I just want to finish with what is the difference. We did accelerated depreciation, we did straight line depreciation. So over 5 years, let's put 30,000 here. We had 30,000 in year 1, 2, 3, 4, and 5. So each year it was $30,000. That's supposed to be a straight line. I can't draw a straight line, but that's okay. So that's what straight line depreciation essentially looks like. It's a flat line. And again, those will add up to $150,000, right? $30,000 a year for 5 years. Total accumulated depreciation total of this $150,000. Now, earlier, I talked about there can be these accelerated methods. One of them is double declining balance. I'm not going to require you to know how to do that, except I do think each one of you need to understand that there can be these accelerated methods, and what difference does it make? You may want to use one of those when you own your own business. So accelerated means we'll have accelerated depreciation early on in the asset's life. If we had used double declining balance, this would be $63,080 in year 1. We're not going to do the calculations. I just want you to understand what's going on. And then in year 2, it would be something like $37,848. So it's accelerated, but it's going to go down because we can't do 63,000 each year. We would exceed the 150,000. So the 150,000 will be allocated differently for an accelerated method. So we'll have a lot of depreciation early on, and then later on in the asset's life, it will turn itself around. So year 3, 22,709, and then year 4, even more down. It'll only be 13,625, and then year 5, a pretty small amount, only 12,738. So the accelerated will have a downward line, right? Kind of follow these around to go down. So this is an accelerated method. But if I add those up, the 63, the 37, and all of these down here, it still totals 150,000. So in the long run, I still depreciate the asset. I have $150,000. But let's look at, well, what difference then? If it's kind of all work out the same in the long run, then why would anybody bother doing this accelerated depreciation? So let's look at what before it turns itself around, while we have higher depreciation expense. So earlier on in the asset's life, we will have higher depreciation expense. Now, if we have higher expense, what does that do to income? Larger expenses means less income, and thus less income taxes paid. So less income, I'm going to do this. Less income before taxes. Let's put that step in there. If we have less income before taxes, we have less income taxes paid. So we'll make it 3 steps. So we have a larger expense on the income statement, so less income before taxes on the income statement, but we will pay less, we'll have a less income tax expense, so less income taxes paid. Now, let's go down here at the bottom where it flipped. Where it flipped and accelerated became a smaller amount. So in this case, the accelerated depreciation has a lower depreciation expense. And if it's a smaller depreciation expense, then we have higher income. So we'll put higher income before taxes. Now, if I have a higher taxable income, I am going to have higher income taxes paid, higher income tax expense, and higher income tax, and thus higher income taxes paid. Okay, so this gives you a picture of when you own your own business, do you want to do straight line? Or would you like to save on your taxes here in the short run, but then it does turn itself around and you'll have to pay more later on. But accelerated is often used for the short-term tax benefit. Let's put the word tax there. So it's often adopted, folks looking in the next few years and the tax benefit.